Is Luke Robinson. I'm a new business advisor here at Collective, your all in one solution for your business of one. And today we have an exciting event happening that we do every week on a Tuesday. We like to call it a Tax Tuesday. And essentially, what it is a AMA. It's an Ask Me Anything about how to run your taxes, how to run your bookkeeping, and just how to run your small business finances, administration, and taxes in general. And please, in the comment section here, please, ask any question that you'd like. I already have some questions that people have already asked in preparation for this event. So thankfully, we've got a good place to start. So let's go ahead and get started. The first question we have: can 1099 contractors be on payroll? Well, of course they can. And really, unfortunately in taxes, especially US taxes, these terms can get confusing. What does payroll even mean? How does it relate to 1099 contractors? Really, payroll, just in a general term, the term payroll means a system to pay employees or contractors. That's what payroll is. But it works a little bit differently, whether you have employees or 1099 contractors. There's this little pesky thing about US taxes. It's called the self-employment tax. It's what it is. Another word for the self-employment tax is Social Security and Medicare taxes. That is literally what the self-employment tax is. So, when you're 1099, completely 1099, you are self-employed. So therefore, you pay the self-employment tax. It's a flat tax rate of 15.3%. So, let's say that you're a 1099, your net income is $100,000. How you'd come up with your self-employment tax, generally speaking, is you take $100,000 times 15.3%. That's how you do it. If you are an employee, if you're a W-2 employee working for someone else, you still pay self-employment tax because you pay Social Security and Medicare taxes. It's the exact same tax rate. It's the same thing. The only difference is when you're a 1099, all of your money is subject to the 15.3%. But when you're a W-2 employee, your wages are still subject to that same 15.3% self-employment tax or Social Security and Medicare tax. Another word for it is payroll tax. They're all the same thing. Your income is still subject to that 15.3%. The only difference is your employer pays half of it for you. Just by law, they have to pay half of that 15.3%. So, let's say that you make $100,000 in a W-2 wage. How you would, as an employee, your share of self-employment tax would be around 7.5% because you only pay half of that total tax rate. So to get back to the original question, can 1099 contractors be on payroll? Yes, they can. If you have a payroll system like Gusto or ADP or some sort of system a software that runs your payroll, you can pay them. You can pay 1099 contractors on that payroll provider. But just keep in mind that your tax implications will be different, depending on if you choose to pay them as 1099s or W-2 employees. So if you have a 1099 contractors that are working for you, you pay them, and you yourself don't owe any payroll taxes when you pay 1099s. That is up to them. When you receive 1099 income, it's up to you to pay that 15.3% self-employment tax. So, but let's say that you have W-2 employees. They're not 1099 contractors, they're employees, and you pay them a wage. You have to pay half of their self-employment tax, of their Social Security and Medicare taxes. So let's say that you pay a W-2 employee $100,000. That's their salary. That's not all you're going to pay. What you're going to pay is $107,500 because you pay half of that 15.3% for them. You pay the 7.5%. Here's a good question. I'm an international student working in the US. I was told last year I owe more taxes than what was withheld. How do I double check if I was supposed to pay that extra amount? I already paid it online. Well, thankfully speaking, if you overpay in taxes, you can get it back as a refund. And really, the only way to check how much tax you actually owe, or is if you overpaid, is to file your tax return, or at least prepare your tax return for that tax year. So let's say that last year in 2022, you made a certain amount of money. Let's say you made $100,000 and you paid them, through your estimated tax deposits or just, your withholdings, however you chose to pay the government. Let's say that you paid $20,000 in tax. Let's just assume that. But let's assume that your tax return only shows that you owe $10,000 in tax. When you do that, then you're good. You don't have to pay the government anything. You don't have to write them a check because you've overpaid. Now, then you should get a refund. And if the IRS doesn't automatically request, or I'm sorry, if the IRS doesn't automatically issue a refund, you can give them a call and say, hey, what's going on? I overpaid in taxes. Could I get that check issued back to me? And how you check on the tax payments that you've made, you can go to the IRS website and request tax transcripts. And transcripts is essentially just a record of all the financial information or all the financial happenings that have happened on your account with the IRS. So specifically, there are these documents called account transcripts. And it's just a record of all your transactions with the IRS, how much tax you owe in a certain tax year, and how much taxes you've paid in that tax year, whether it's from just estimated tax deposits that you've paid the government directly, whether it's from W-2 withholdings. Those transcripts will show how much total tax that you've paid. So if you'd like to double check, you can obtain those transcripts and just add up how much tax you've paid in that current year. It'll show it on the document, and compare that with how much tax the government or the tax return claims that you owe. And if you've overpaid, then you can get a refund back. You can call the IRS and request a refund. If you've underpaid, if you owe taxes, you got a couple options. You can either write them a check, and if it's past the payment deadline of April 15th of that year, then it's likely that you might owe some interest and penalties. But you could pay that, just pay them as soon as possible. Write the government a check. You can typically pay them online. That's another option. That's the general sort of process to go to figure out how much tax you've paid. Do you have to pay business taxes out of a business account? No. Well, let me back up a little bit. For a vast majority of small business owners, you aren't paying business taxes out of a business account because there are no business taxes, to the federal government at least. There are no, for example, a vast majority of people with small businesses, when they set up a business entity, they set up an LLC, vast majority of the time. And an LLC is a pass-through entity. There are no federal business taxes on LLCs. So there are no business taxes to pay out of the business account. It's all personal taxes. And really, when you have an LLC, there are two types of taxes that you're dealing with. You have the income tax on one side, and that's what most people think of when they think of taxes. The income tax is what you pay, what you calculate on your tax return at the end of the year, those marginal tax rates that you pay. And you also have the self-employment tax. That's another important tax rate. And those are both personal taxes. They aren't business taxes. It's a pass-through. That's what an LLC is. So all your income from your LLC, from your business, goes on your personal tax return. So you actually pay taxes from your personal accounts because they're personal taxes. There are no business taxes. So no, you don't pay, in a vast majority of time, you do not pay business taxes out of a business checking account. However, if you are a corporation, meaning that you have double taxation, meaning you have corporate tax rates, and the corporation itself pays income pays taxes on the corporate income, on the corporate net income, the business level. And then you pay taxes again personally when that net income is distributed to shareholders, either through salary or through dividends, things like that. So that is when a business would pay business taxes out of a business account because it's a corporation. And when you're a corporation, you have corporate taxes. It's called, double taxation. But again, a vast majority of people don't need a corporation. And even if a small business owner does have a corporation, how you can avoid the double taxation is to make an S Corp election. An S Corp tax election is to become an S Corp. And that brings me into my next question. What is an S Corp? And the first thing that I would say is an S Corp, and a lot of people have a misrepresentation about this. An S Corp is not a business entity by itself. It is a tax election. An S Corp is not necessarily a corporation. Unfortunately, the IRS likes to confuse us with their terminology because you would assume that it was a corporation, right? You would assume that it was a business entity because it's literally called an S corporation. That's not the case. It's a tax election. It's a way to choose how to be taxed. So, for example, let's say that you're an LLC and you'd like to be taxed under the S Corp tax rules. You set up the LLC first, you register the LLC with the state, and then you make an S Corp tax election with the federal government, with the IRS. You send in paperwork to them to ask to be taxed as an S Corp. And that form is called Form 2553. That's the form you fill out to become an S Corp. And what that does, technically speaking, is it turns you into an employee of your own business, of your own operation, of your own LLC. You remain the owner of this business. You're still, listed as the owner on the company formation documents. But for tax purposes, you literally become an employee. And since you're an employee, you pay yourself a wage. Your business will pay you a salary, literally, just like you'd receive if you work for someone else as a W-2 employee. But the advantageous thing about S Corps is it allows you to avoid a large chunk of the self-employment tax. Before you become an S Corp, essentially all of your money is subject to the self-employment tax. So if you made $100,000 as a self-employed individual, how you come up with your self-employment tax is you take $100,000 times 15.3%. That's what the self-employment tax is. But when you become an S Corp and you become an employee of your business and you pay yourself a wage, now the only chunk of your earnings that is subject to the self-employment tax is your wage. The rest of your money is called a distribution. Another way to think about it is a dividend. That's another common term that people use for S Corp distributions. And those distributions, those dividends, are not subject to the self-employment tax at all. So let's go back to our previous example. Let's say that you're making $100,000. And let's also assume that you pay yourself $40,000. Let's say that you pay yourself a $40,000 W-2 paycheck. Before, it was $100,000 times 15.3%. That's how you come up with your self-employment tax. Now with an S Corp election, how you come up with the self-employment tax is you take the $40,000 times 15.3%. That's the only chunk of money that you pay that tax rate on. So now the other $60,000 are your distributions. And that is the chunk of money that is not subject to the self-employment tax. These distributions are still your money. You can still pay yourself these distributions. You can pay yourself these dividends whenever you'd like, whenever it's most convenient for you. That money is not locked away, or that money does not have to sit in the business bank account forever. You can take out that money whenever you'd like. And that money is not subject to the self-employment tax. So, giving that example, how you'd come up with your self-employment tax savings is you take $60,000 times 15.3%. That's what you do. And so what you save is $9,100. $9,180 to be exact in the self-employment tax. I sold a house in owner to in I sold a house in owner to rent. They're making monthly payments to an LLC in a bank account. Do I have to report tax? If this is the case, how should I do that? I'm having a little trouble understanding your question. I sold a house. If you sold a house to someone that you owned, typically there are some exclusions to where you don't have to pay tax up to a certain amount. I need to double check and see if the numbers are correct. But typically, if you're single, if you're not married, you can exclude up to $250,000 in gains from that house to where you're not paying tax on it. So let's say that you bought a primary residence for $150,000. And let's say that a few years down the road, you sell it for $250,000. That is $100,000 income, positive income that you've received from selling that asset. Since that 100 grand is below the $250,000 exclusion amount, you don't owe any tax at all. I hope that answered your question. And for married couples, that bumps up to $500,000, 500,000. So whatever profit you make, as long as it's under $500,000 and you're married, then you don't owe any tax on that. Oops. I'm currently a 1099 and I need to change to an S Corp. Can I write off car expenses being a good 1099? And also what is the difference of my write-off if the car is under 6,000 pounds? Honestly, it's typically not a good idea. Let's say that you're just a 1099 or you have an LLC set up and you have a personal vehicle that you're using for business. It's typically not a good idea to write off the car directly. The IRS doesn't really like that. Now, it's possible, you can do it. What you would do is you would write off, essentially, you could depreciate the car. You could, write off actual wear and tear, things like that. But usually the IRS only wants you to write off a car directly when that car is owned by the business, when that car is exclusively for business. So let's say that you own like a fleet of rental cars, or you have a company and it's a specific company car that you don't use for personal use. Then you can write off that car directly. But if you're just a 1099 and you're using your personal car for business, it's a lot better of an idea to write off the standard mileage rate. And all you have to do in that situation is determine, how many miles per year annually are due to business. And you would take that total number of mileage and you'd multiply it by the standard mileage rate. It's something like it's approaching 60 cents per mile or something like that. That's typically the best idea because it raises your risk for audit quite substantially if you write off your car directly with an LLC, if it's not exclusively used for business. And, I've seen several situations where, someone has gotten audited and since the car was not, exclusively used for business, they disallowed all the car expenses. And that's not a fun place to be in because, typically that can make you owe a lot more tax later on down the road. Also, is the amount going to change on how much you can write off next year? I have no idea. It just kind of depends on what the IRS releases. Typically, they will increase the standard mileage rate. Okay. Is it too late to be an LLC for 2023? Well, it's too late to be an LLC for the entirety of 2023. But you can still be an LLC within this tax year. All you got to do is form an LLC. So let's say you form an LLC now and it's registered on, August 25th. That's when you start becoming an LLC. That's when you can open up an official business bank account that's linked to that LLC. You can have clients start paying that business account. and that will provide asset protection, and separation from your personal finances and your business finances. So if you're interested in becoming an LLC, I do it as soon as possible. And as much of the year that you can, be an LLC, the better. And also, too, if you are interested in becoming an S Corp, you can only become an S Corp when you're an LLC first. You've got to set up an LLC before you can make an S Corp tax election. So that's another reason why it's important to, get an LLC up and running as soon as you can, because it allows you to become an S Corp as soon as you can. And there's a fun little trick to where if you don't currently have an LLC, if you're a sole proprietorship, then you can't backdate an S Corp election. Like for example, let's say that you were an LLC for the entirety of this year, the whole year. Technically speaking, you can backdate the S Corp election to the beginning of this year, technically speaking. But if you don't have an LLC, you can't. But what you can do is you can backdate it to the beginning of the month that the LLC was formed in. So let's say that on August 2nd, you got a huge payment from your client. Let's say you got a $20,000, $30,000 payment from your client in August. And let's say that, a company is able to form an LLC for you in the month of August, even if it's August 29th. As long as the LLC is formed in the month of August, you can be considered an S Corp starting August 1st, the beginning of the month. So it's a way to, even if you had money coming in when you were a sole proprietorship, as long as you get it set up in that month, you can rope that money under the S Corp tax rules, and you can capture more money and save in the self-employment tax. So if I switch to an S Corp, and if the car doesn't weigh over 6,000 pounds, can I still write off 80% of the cost of the car if it's strictly used for business purposes? The rules on that are pretty complicated. It's a little complicated for this forum, honestly. But what I would look into is I believe it's called the Section 179 deduction. And essentially what that does is it allows you to kind of immediately write off a business expense. So let's say that, business expenses like cost of machinery, qualifying equipment, things like that, including a car. And what that does is instead of depreciating the car, over a certain amount of time or, waiting to write off expenses per year, you can write off thousands of dollars of expenses at once. But again, I would speak to an accountant about that. The rules are complicated and extremely specific, and I'd be careful. The IRS has more funding. They're ramping up their audit rates, and they just announced that they're going back to historical audit rates for people that are making below $400,000. Now, the Biden administration and the federal government, they've said, or in the IRS in general, they have new funding. They have billions of dollars of new funding for tax compliance and tax enforcement. So, and they've said that they're not going to enforce or increase, tax compliance or enforcement over people making below $400,000. But what they are doing is they're returning to historic levels of audits for people making below $400,000. So they might not necessarily be increasing the amount technically overall, but they're going back to what they used to audit, the rate at which they used to audit those people. And it used to be higher than it is now. During the pandemic, they slowed down a little bit. The past few years, they've slowed down, but now they're ramping back up. So it's extremely important to be careful about these things. How can I start prepping for tax season? That's a great question. If you're self-employed, one of the most important ways to start prepping for tax season is to get your bookkeeping in order. Come up with a profit and loss statement. And a profit and loss statement is simply what it is. It's how much profit that your business makes, how much income, and how much you've spent, how much in business expenses, in payroll fees, software expenses, things like that. And then you get your net income. And you're only taxed on your net income. So I think that that would be the most important thing is to, get your accounting in order, get a profit and loss statement ready so you can file your taxes come the beginning of the year. Also, I would go ahead and start, if you haven't already done so, I would go ahead and try to start to calculate how much tax you owe and if, how much you need to pay to cover your tax bill for 2023. So if you're self-employed, if you're 1099, have your own business, you're required to pay estimated tax deposits. So it's a good idea to, refresh and, figure out how much you've already paid and how much you need to pay, come tax time. So you can be prepared, so you can take out a loan if need be. Let's say that you got, behind in your taxes. It's usually better to take out a loan to go ahead and pay them to, get the federal government off your back. So those are the two main things that I would say to prep for 2024 or 2023 tax season. What is a retroactive S election? A retroactive S election is essentially backdating an S Corp election. It's when you have gone through a current tax year, you've done business over the past few months, and you weren't an S Corp, but you look back and you determine that you needed to be, that you've made enough money to where it's worth it, that you'll see, quite a bit of tax savings in the S Corp with the S Corp tax election. It's, theoretically possible to backdate an S Corp election. And what that involves is what we would do, or, a company like Collective or someone else like us, is we'd send in form 2553. That's the S Corp election form. And we would write an effective date on that form to start your S Corp. Collective specifically will go back to July. We would backdate it to July 1st. But there are some firms out there, of course, that'll go back to January 1st. It is extremely expensive, and it's usually not worth it typically to go back to, all the way to January 1st. But let's say theoretically that you wanted to. They'd send in the form 2553. They'd list on that form the date that you'd like to become an S Corp. So they'd list on the form January 1st of 2023. As far as the government is concerned, you are now an S Corp for the entirety of 2023, but you're not done. Because when you become an S Corp, there are other sort of administrative things that you have to take care of. When you're an S Corp, you have to run payroll. You have to be on payroll. You have to pay yourself a W-2 salary. So you have to go back and run back payroll, which means reclassifying your income, some of it as W-2 salary and some of it as distribution. And that's how you save in the self-employment tax. That can be pretty complicated. Another thing you have to do is fix your bookkeeping. Since you have payroll expenses, other things like that, you have to go back and add in those expenses, tweak your bookkeeping. But what you also have to do is you have to include a balance sheet into your bookkeeping, into your accounting. Whereas before, if you're just an LLC, if you're a sole proprietorship, there is no there is no balance sheet. You don't have to require, you're not required to track a balance sheet. So that's another thing, is to go back and, include a balance sheet. What if I don't make money this year on my S Corp and wasn't able to pay myself? Basically only operations cost. What happens then? That's such a great question. You're fine. You're okay. You're only required to pay yourself salary if your business is making money. If your business hasn't made any money, you're not required to pay yourself salary because there's no money to pay yourself salary with, So essentially, let's just assume that your business doesn't make any money, but you still have operation expenses, operation cost. Your business now has a loss. That's okay. Businesses can have losses. It's very common. And when you make an S Corp election, you now have a business tax return. You have an S Corp tax return that you need to file. So at the end of the year, your profit and loss statement will be, you're making enough money to pay operation expenses. Well, essentially that means that you've zeroed out. You don't have a loss, but you don't have much net income. you'll just record that on your S corp tax return at the end of the year. So let's say that you've, had $5,000 in income, and you have, $5,100 in expenses. You have $100 loss, and the tax return will show that, and that's how you report it to the government. So if the government is aware that your business hasn't made money, or if your business broke even, then they're okay with you not paying yourself a salary. You should be fine, because there's no money to pay yourself a salary. But you are still an S corp, and you're still required to file that S corp tax return, even if you haven't made money. That tax return requirement is still there. And unfortunately, that is all the time that I have today. I actually have another a conversation with a prospective collective member. I hope you enjoyed it and found this session informative. And we'd love to see you next week for next week's Tax Tuesday.